Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. The Bullington Capital Show. Just a man and his mic and his marketing manager and the board operator and the telephones. Feel free to call us if you'd like, 216-901-0945, 216-901-0945. Just got back from a seminar. Thank you very much for all the people that came out this morning. It's a lot of fun. We're talking about different ways to generate income, and the primary way we talked about today was just setting up a portfolio of bonds that are going to mature. It could be CDs, by the way. In fact, CD rates are higher than Treasury rates are. So if you were looking at bonds with the government backing, CDs are actually paying a little bit more than Treasuries are. Not a lot. And the interest rate on this, some gentleman brought it up during the show. The interest rates are relatively low, but they're there so that you can actually let them mature and fund your retirement, basically your basic living expenses. And you can be sure about that. So you can take the rest of the money and you can invest it in stock funds or other types of investments. The idea being that you want to keep your income guaranteed over a certain time period, and you can pick what that time period is, and then you can actually be a little bit more aggressive with the other money if you know that that income is already taken care of for that time period. So that's kind of the basic concept there. And feel free to email if you have questions. You went to the seminar. If you're listening to this and you have questions, you can go to my website, bullingtoncapital.com. There's a contact us page. Just email us a question if you have one. In fact, we did get a question from somebody that came to the seminar this morning, and he said he wanted to know if the Brexit losses loss was exacerbated by a mandatory change in an index. And not to my knowledge, I don't think they were exacerbated by changes in the indexes. But that could be the case. My instinct tells me it's probably not, wouldn't have a significant impact anyway. And I will double check that, and so stay tuned next week. We'll come back to this. But is the S&P changing to 11 groups, adding REITs? Will this affect your high dividend model? The answer is actually yes, it will affect the high dividend model, but not by a lot. Right now, there are 10 sectors that the people at Morgan Stanley decided to break up the S&P 500 in, or the stock market rather, and 10 major sectors. They're going to increase that to 11. Right now, with the high dividend model, we hold the top 4 dividend-paying stocks in each of the sectors. So that would go from 40 to 44 stocks if we were breaking them out. And I don't have to do that. I could actually combine those two sectors and just keep it the same way that it is now to hold on to just the 40 stocks. And by the way, when I say 40 stocks, I know the average person is driving down the road and who buys 40 stocks? Well, listen, there's a technology out there. You can buy 40 stocks with $1,000. Literally, you could buy you could take $1,000 and buy 40 stocks, even if Google's in there. How? Because they buy fractional shares. They're one of the few firms in the country. It's a firm called Folio Investing. I use Folio Institutional. That's for people that manage money for a living. But you could go there to their retail site, and you could put up to 50 stocks in a portfolio with as little as $1,000. They will literally buy a piece of all 50 of those stocks. And you could do as little as you want. So when I say you can design a portfolio, if you can dream it up, I can design it, build it, and run it, and administer it. I'm telling you, the technology's there. It's available. And that's what we use for an awful lot of the money. We use Fidelity too. In fact, if I'm doing bonds, and we were talking about bond ladders, if I'm doing bond ladders for people, I'm going to use Fidelity for sure. Their fixed income department is one of the bigger on the planet, one of the largest on the planet, rather. And it's relatively simple. They have a special interface for institutional wealth managers there that we use. very similar to the one that the retail people use. Ours, I think, is slightly easier, but I would use Fidelity when it comes to buying bonds, government bonds, tax-free bonds, whatever. That's the platform that I would use for that. Everybody's got their strengths and weaknesses, and I think it's kind of important as an advisor to kind of look around and see what's there. I didn't use Folio for a long time because they were a brand new firm. They only started in 1999, and I was afraid. And I saw Bear Stearns and Lehman Brothers go under. I know what happens when a company goes under, the reorganization process. I mean, you could be out of commission for as much as 6 months until they figure out how to transfer your securities to another broker-dealer. And if you're above a certain dollar amount, there's no insurance or guarantee on that. So when I'm looking at a new vendor, I look pretty carefully. It takes me a long time to even dip my toe in the water. But having said that, I really like Folio a lot. It allows me to do the high dividend model that we talked about this morning, which I'll talk more about a little later in today's show. It's basically what I just discussed, taking the 10 sectors that make up the market, buying the 4 highest dividend yielding stocks in each of those sectors. Now, I rebalance mine once a quarter. There are some ETFs out there that do it once a year. I'm not comfortable waiting an entire year to rebalance the portfolio because a lot can happen. Actually, a lot can happen in 3 months, as those of you that attended the workshop can attest to. When you see the results over 1 3-month time period and you see how much up or down they are, that's an eye-opener. I mean, it's really fascinating to see how fast stocks can move in both directions. Now, and these are large companies that pay dividends. So that's it's a trip. And quite frankly, until I had access to Folio, I really never looked that closely. I wasn't really that interested in this stuff. I think the dividend stocks are a function of 2 things. Number 1, I'm getting older. Number 2, my clients are older than I am. So dividend paying stocks, I think they're still a good deal. You look at valuations. I talked to somebody this week that said, well, the valuation of the S&P 500 is 20 times earnings. Okay, those are trailing earnings, not forward earnings. And the top 50 stocks in the S&P 500 make up a whopping percentage of that. And if you subtract those stocks out, the average valuation is it's actually slightly undervalued. You look at small mid-cap stocks that were down 25% last year that nobody talked about. They're down a lot. I mean, they're undervalued. So it really depends on what area of the market that you're looking at. The current yield, that's the current yield on a dividend model is right around 5%. That's pretty good. I wouldn't call that overpriced. Definitely not priced for perfection. All those terms that people like to use for telling you, try to gauging the risk in the market today. And I think the thing that really amazes me is how low the 10-year treasuries are. That is mind-boggling. I literally would not have believed that the 10-year treasuries or even the 30-year treasuries would get down to the level that they are in the current economic environment that we're in. Because we don't have a lot of growth, but we do have growth. It's slow growth. But these interest rates, and I know why, we've got a lot of debt. But even in the 1940s, after World War II, when debt as a percentage of GDP was significantly higher than it is today, we owed more relative to our income after World War II, because we had to pay for all that, than we do today. So when people start talking about the, $18 trillion debt, yeah, well, you add $200 or $300 billion to that, and now you're approaching more closely what it was after World War II. And so we've been here before. And interest rates, interestingly, were higher after World War II than they are today. So I like to say a lot. Anything can happen, and probably will. Some people that have been around me for a long enough time period realize now what I mean by that. When I was coming out of high school, interest rates on a mortgage, 22%. A 22%. And you had to put 20% down. It's crazy. Yeah. So when people that harken back for the good old days, like, man, you get checked for Alzheimer's? It's the good old days. They weren't all that good. These are the good old days. Things are good. Interest rates are low. Low growth. I think that's probably going to speed up a little bit. Why? That concept of reversion to the mean. It's been below average for 8 years in a row. Sooner or later, it goes back to average. Average is a whole lot faster than what we've experienced. The catalyst is probably going to be a new president, whoever it ends up being. And it'd be hard to go a lot slower than we've been going. So I'm optimistic. Here's my fear. This is my fear about financial markets. It's not a big one. I don't let it keep me up at night. But if people finally figure out that they're not going to raise interest rates, that they're going to they finally give in and say, okay, I give up. This is it. This is how low interest rates are going to be, just like they've been in Japan since 1989. What year is it again? 1989. People finally throw their hands in the air and say, okay, yeah, interest rates are never going up again. The stock market's going to double because the earnings yield on the stock market right now is 5%, and 5% is a lot better than 1%. And it's a heck of a lot better than Europe, where they actually charge you to hold your money for you. There's a negative interest rate. You have to pay them money to hold your money, to keep it safe. And so, again, anything can happen, probably will. It's probably one of the reasons that I think that some of the technology that's been developed, that's ready to be put out there, there are tons of things literally millions. Improvements in the grid. It's not like we don't need that. The grid needs to be improved dramatically. It should be. The grid should be operating like the internet does. You know, when a internet hub goes down, or connection point, junction, whatever you want to call it, it reroutes your data to another place so that was the idea behind it, was to reroute the data. And was actually done for the military originally. It was called ARPANET. And it was done so that people could contact each other, military people could contact each other securely in the event of a nuclear war. Believe it or not, that was the founder of the internet. So, by the way, when you hear people complaining about the government wastes all that money, well, the government paid for the internet. They paid for the internet. You're paying it now. Some of it, government still pays for an awful large percentage of that, but that was the government. So, and they need to step in, and they need to do these things. They know they need to do it. They know the infrastructure is aging. It's not just the electric system, which is a big one. The demand for energy is growing faster than the population growth is. Actually, I think it's growing nearly twice as fast in the United States, because the first thing a kid does when he gets 16 is he wants to get a car, and they're going more and more hybrid and electric. Will be plugging in. First thing somebody does when they come to this country, by the way, a significant portion of our population growth is immigration. And without them, things would be a lot different, and it wouldn't be better. Immigration is not a bad thing. It gets a bad name. It's a bad rap. Some of it, yeah, because you know what? You're letting people in, and not all people are good people. But you can't avoid that. Will you promise to behave? That's part of your pledge of being an American. I don't know. But the bottom line is there needs to be an awful lot of work done. The first thing somebody does when they get here, they want to get a cell phone. That cell phone has to be charged. They typically don't want to do without a refrigerator, air conditioning, all these things that require energy, and nobody thinks about that. And the demand for energy is growing faster than the population growth is, because we're finding more and more things to do with electricity. As I sit here and I look at my laptop, it is amazing that it's full color, pictures, video, all that stuff. Somebody tells me 25 years ago what I'd be doing today, I think they probably just escaped from the loony bin. Yeah, you've been doing something. You've been to Colorado lately? No, that was a bad. That connection didn't even make. I was talking about the pot's legal out there. But anyway, bottom line is we've got a lot of projects. We've got way more projects to do than we actually have money for. We need to release some of that money and get some of these things done. It is important. Internet connection, yeah, it's important that you're able to get up and update your Facebook account even if a nuclear war happens, but probably a little more important that you have the electricity. to get on the internet. I mean, come on. But you can graduate from college in the United States with a PhD without the ability to think. Incidentally, if you have a really good memory, you can memorize your way all the way through. So when you hear people talking about how bad things are and how negative this, you know what? They've never been quite as good as they are today, and opportunities are there. You look at there are an awful lot of stocks who are selling below where they should be. Are some of them selling higher than they should be? Yeah, but that's always the case. It is always the case. And it just so happens a lot of them make up a big chunk of the S&P 500. Another reason I would probably be staying away from that particular index for the next few years. The next few years, probably not as good as the last. Next 5 years, probably not as good as the last 5, unless there's a major shift within the index. And that can happen. It generally takes it a little more than 5 years to happen, which is why I would probably not use that. If you've been using it, I would probably cut back on it going forward. Getting back to my fear is that it'll keep going higher because people keep buying it because it's going higher. That's the same thing that happened in 2000, late 90s. That's my fear. S&P 500 goes to 3,500. People are up 75% or so. A lot of funds or other strategies, they'll be up 100. And everybody's going to want in at that point. And at that point, it's too late. You've missed it. If it doesn't happen over the next 4 or 5, let's say it happens slower, and it takes it 8 or 9 years, 10 years. So if you've doubled your money in 10 years, that's actually not bad. It's not as high as the long-term average. It's still not bad, especially when you're looking at a 1% CD. And a CD that's not likely to go up a lot anytime soon. And this is where cognitive biases come in all over the place. That's a really fancy term. That means people ignoring the facts and believing what they want to believe despite the facts that the facts don't support their belief. So they're choosing to believe what they'd like to believe because it's more comfortable. And it's not comfortable for me to sit here and talk about how that is probably not the way things are going to happen because I know what people are thinking about out there. They're hoping I'm wrong. They're hoping that CDs go back to 5 or 6% or wherever they want to go back, even 4 or 5% at this point. Well, let me point something out really briefly. If you increase the $11 trillion of interest-bearing debt by 1%, and by the way, I know it doesn't happen in a year. Now that here's the music, I'm going to have to finish this thought when we come back from this commercial break. Listen to Bill Bullington right here on 1420 The Answer. Stay tuned. That's interesting music. You remember those guys? That was pretty funny on television. They're actually pretty good. I just lost my whole train of thought there. So I have my marketing manager here with me today. She was at the seminar this morning. She's following up with some of the people that had requested questions. Anything that you can think of that you think I should touch on? Actually, you have to speak.
I can't think of anything right now. I'm trying to think. A lot of people had questions about, Brexit, and it was a really good seminar this morning. Very insightful about the bond ladders and the high dividend model. I thought that was very informative.
Yes. You have to say that actually. Yeah, I'm just kidding. But no, thanks. That is interesting. The Brexit thing, because that was pretty recent. And it's funny how quickly something like that fades from the minds and memories.
Sure.
And it really, is it significant? Like we talked about, the full impact's probably not going to be felt for a while. They're still dealing with it. But from a psychological impact, it had a big impact initially. And then when people kind of settled down, not people really, it's the institutions. Institutions will sell in anticipation of having to meet redemptions from the investors. Now think about that for a second. So you got an institutional money manager manages billions of dollars, starts raising cash because they're anticipating people they're going to want to cash in, and they have to raise cash to meet the redemptions on the funds. So what happens to the stocks? They go down. And then when the redemption orders didn't come in as fast and as hard as they thought they would, uh-oh. And that's what you get for trying to anticipate. But that should be one of the... We need to have a slogan for that. And I was thinking about a conversation we had the other day, coming up with a logo. I am not anti S&P 500. I don't think it's the right thing for an awful lot of people. If you're really young and you don't want to have to think about it, and you're okay with going through a couple of 10-year time periods with negative returns, think about that for a second. If you're okay going through a couple of time periods with negative returns over a 10-year time period, then by all means, buy the S&P 500 fund. If you'd like to do a little better than that, then you might want to steer clear of that and look at some alternatives, which is essentially what we're doing. So I got this thing on my laptop, and I took a screenshot of the S&P, and it's from Telechart, actually. Shows how it peaked in the year 2000. It gets back to break even right around the end of 2008, right before it drops 50% again. This time it went down a lot faster than it did the first time. The first time was more like Chinese water torture. It peaked in March of 2000, did not bottom until the fourth quarter of 2002, and then it rallied and dropped again in the first quarter of 2003, so it was nearly down to the same level 3 years later. That was Chinese. That's a 3-year decline in the S&P 500. 3 years. Then it slowly chugs its way back up, and near the end of 2007, it peaks again, goes slightly higher, and then you hear the media, all-time new high, and everybody's thinking that they should be rich. Well, it's just getting back to where it was 7 years ago, and then it drops more than it did the first time, and that actually lasted for about 15, 16 months. So it was over a year. And by the time... And somebody says, well, didn't they pay dividend? Yeah, the dividend yield on the S&P 500 in 2000 was 1.7%. So did they raise it over the years? A little bit. It got up to almost 2% in 2007. Dividend yield was not much help there. Backs back down, and it's somewhere around 2013. If you reinvested your dividends the entire time before you got back to a break even from where you started in the year 2000. And I'm pretty sure that's one of the reasons that people that are in your age bracket, the, what are they called, the Millennials? I'm pretty sure it's why a lot of Millennials don't trust the stock market, because they've had horrible experiences. The vast majority pulled out at some point in time. Something scared them. They thought it was going to be another 2008, 2009. They went to cash, and then they missed a big chunk of the rally. They got back in the market, and then it went down again. So that's what kind of shapes the minds of a whole generation of investors, is what their experience was when they first started making money and saving money and investing money. That first few years is going to have a really large impact on the rest of their lives. I remember when I was your age and in the business a few years, I was talking to people who had been alive during the Depression. Now, they didn't want to hear anything about stocks ever.
Sure.
Not all of them. Obviously, some people did. But when I started in the industry, only 15% of households had any money in stocks.
Wow.
And there were only 1,500 total mutual funds. There were around 7,000 or 8,000 stocks at that time that you could invest in off of either the NASDAQ or the New York Stock Exchange. Most of them the vast majority of those were really small. They were super small companies. Some of them went on to become really big companies. But, it's a lot different. But the experiences that people have still have an impact. That part hasn't changed. the experience someone has the first few years that they're in the markets, especially when they're not teaching this in business school, unless you were a finance major with an investment management finance major. Find a school that's got that designation. That's very difficult to do. You probably saw a little bit of data on this. When I was an econ major, we spent an incredibly small amount of time on financial markets, other than the bond market deficits and that kind of thing. We really weren't looking at stocks and their returns. So what's happened, what I've been able to observe throughout my career is that whatever somebody experienced those first few years out of college has had a major impact on the rest of their life. And that can be fortunate or unfortunate. Because if you graduated from college in 1999, got your first job in 2000, and had invested religiously and had literally and kept track of your investments, a lot of 401k plans will do that now, and saw that your average annual return was 0 after 10 years, you are probably not still investing in stocks if you haven't already given up on them. So anyway, that's kind of what it's like to be a financial advisor. People are subject to their own experiences. That's the way they think it. Typically they project that out into the future, and it's unfortunate because markets do change. And the thing we were talking about this morning was how quickly the certain strategies recover. Like a dividend-based strategy normally recovers quicker than a non-dividend paying strategy does. So if you're investing in smaller growth companies who are growing real fast, when they drop and start to come back because you've had a major market correction, it typically takes them longer than it does the stocks that pay dividends. And I think that's something that's really important to talk about, not only for people who are older and nearing retirement, but the younger people. If they had seen how quickly their portfolios had bounced back because they were using something like that, a lot more of them would still be investing. And they're going to have to invest. And I'll just ask your opinion. What do you think now relative to what you thought when you first started working there? What do you think would be the biggest differences in your own thought processes?
Oh, geez, a lot. Well, I'm always learning something new every day, that's for sure. But yeah, just, I have a little bit more faith in it. You just got to stick in there, and, it really helps to look at some of the models. I like that ebook that you're starting to write with the high dividend model, just taking a look at all those stocks that were in there by each quarter, and then kind of Googling them and seeing what the headlines were for each company during that time. Some of them you probably wouldn't want to have in your portfolio, and others you're like, oh yeah, but they didn't do so well. So, it's trying to leave that bias and not having attachment to any, any emotional attachments to any companies, and just kind of using the rules.
Right. That's key. What you just said, not having emotional attachments and, following rules. I can tell you that is the struggle. That's the struggle. It's like losing weight. Eat right and exercise more. Or eat less and exercise more. Eating right helps even more. Pretty simple when you come down to it. And getting yourself to be unattached to basically what your opinions are, what you thought should happen. That's the key. That's the key to becoming successful. I think for the vast majority of people who don't have time to look at their portfolios each and every day. Sure. You've got to find a way. And most advisors, we talk about this all the time, almost every day. Most advisors would be much better off just taking a mechanical approach to their investing. The S&P 500 is largely mechanical. The Russell 1000, which is extremely similar, is mechanical. It's mechanical. That's a mechanical approach, and it happens to have very good long-term returns if you're willing to get in there and stick with it. But you've got to become detached. And it's one of the things that I thought was interesting when you and I had first started talking, because you teach yoga, and a big part of yoga is kind of popular with a lot of Buddhists. And a large part of their philosophy is the unattachment, not being attached to the outcome.
Sure. And
being present, paying attention to the process, which would be being present. So I thought you had a really good chance, and you've actually you've grown a lot faster than I thought you would, by far. So that's been a pleasant surprise. So anything that caught you off guard? Not really?
I can't think of anything right now. I'm sure there have been things.
Yeah. I'm putting you on the spot, too. I didn't even tell her I was going to have her on this morning. But so I know that's pretty hard. But you're welcome to think about it and come back
Sure.
if you'd like to.
Sure.
The any other questions you heard that maybe that I didn't answer fully before I started talking about something else at the seminar?
I can't think of anything.
So if you got a question, feel free to give us a call, 216-901-0945. That's the line right here. You can also email us questions, bill@Bullington Capital, or just go to our website, Bullington Capital, and you can click on there's a tab there where you can fill out requests for information and send your question in. Investing is really, it's not as complicated as most people like to think it is. They love to make it complicated. They really do. And I felt bad for one of the individuals. I won't name him personally. He came up after the seminar and he's asking these questions and he's not defining clearly. And I keep stopping him and I keep saying, listen, you have to define clearly, not a few percent. What percent? What percentage are you putting into this particular investment? You need to have a clearly defined level of risk that you're taking. So it can't be I feel, it can't be well I thought. It's got to be very specific, but only if you want to live a life free from attachment. And if you want to suffer, and a lot of people, I'm very convinced that there are a large number of people on the planet who just aren't happy unless they're miserable. And I try to steer clear of them. But the vast majority of people, they just want to, hey, just tell me how it is. Let me try to deal with it. And a lot of them get it. A lot of them we call clients. But it was so funny because he kept coming back to this. Well, no, and I'm stopping him and I'm hammering him. And the only reason I'm hammering this guy is because he's been to a ton of workshops, and I like him. He's not a bad guy. He's not a crazy guy. But when it comes to investing, emotions have a tendency to take over, and that's what I was trying to. You're trying to think about this, and you're trying to develop intuition about what this company is going to do. That is incredibly difficult to do. Incredibly difficult. And I would say the vast majority of the time that works out was really luck. It wasn't the intuition that worked. It was luck, which is a very dangerous thing because now you're reinforcing a bad habit. You thought that it was skill, and eventually you'll find out that it was actually luck. And the way that you find out is rough. And it's really rough to find out that you just got lucky by experiencing bad luck, doing the same things that you were doing when you were lucky. So anyway, got to take a real quick phone call here. I got Daryl in Broadview Heights. Daryl, how you doing?
Hey, I'm doing well, thank you. Thanks for the great seminar this morning.
Oh, thanks for coming.
Yeah, you're welcome. It's also good to hear Melissa.
Oh, thanks. How's it going, Mr. B?
Good morning.
Good morning.
Hey, I saw an article in Consumer Report, and it talks about Robo Investing. It's titled The Rise of the Robo Advisor, with the byline, new digital platforms can manage your portfolio for a fraction of the price of a human financial advisor.
Yep.
Is it time to make a switch?
Yeah. And you know what? You could actually do it yourself for free. The tools are, you don't have to pay anybody anything. Okay. You can also build your own house. You can also work on your own cars.
Which I did.
Yeah. You can paint. And if I work on your car, if I work on my car, it's not going to end up costing me more money. And but there are mechanics out there, and there are people, mechanics. I'm sure they don't pay somebody else to work on their car. If you have the skills and the ability to do it, then yes, you can save yourself some money. But you can say that about each and everything you do, anything anyone does. So the trick is, do you really want to spend the time? And here's the major flaw in the robo-brokers. And by the way, if I thought that was the way to invest, I would tell everybody in my practice to go there tomorrow, and I would put my money there, and I'd go do something a lot easier than what I do. That's what I would do. I promise you I would. And here's
like teaching yoga.
Yeah. And here's the problem, and it's the thing that nobody is listening to, which is why I'll keep repeating it. Remember the first part of the show, I talked about the 10-year negative return?
Uh-huh.
You're going to get that with the robo-brokers. they're using the same research that designed that portfolio. It's the same. And it's one of the reasons that the young people won't invest, because nobody told them what they were up against. They just showed them the 50-year track record. Or look how well it's done in the last 1, 3, and 5 years. And they don't give them all the details. So they're leaving out material facts. And John Bogle's famous for that, leaving out material facts. Well, those material facts are going to show up one day, and it's going to make you really unhappy and can do a lot more damage than good if you don't know about it ahead of time. If you know about it ahead of time, you can prepare for it. Hey, I got to take a quick commercial break, but I'll see you around. I'll talk to you this week, and thanks for calling. You're listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. Hey, if you'd like to call 216-901-0945, 216-901-0945. And again, just to kind of summarize, we got a little workshop this morning talking about the high dividend model, which I'm actually turning into a little ebook. It's almost done. The text, we just have to send it to the editor and we'll pop it out there. And I think it's a really good idea to go in and look kind of behind the scenes at the strategies. One thing to describe what you're doing. It's another thing to show people how it's actually performed in minute detail. As that is and by the way, these are hypothetical illustrations. If you had done this at this time, this is what would have happened. There are all kinds of disclaimers that go along with that because nobody is going to get the exact same returns. If you start a couple of hours later than someone else, your returns are going to be different, good or bad. They're going to be different. If you start a week or two later, they're going to be different. You start a month or two later, you look at how fast a whole basket of stocks can move. Actually, a couple of hours can make a big difference now. Now with the flash crashes, that's kind of a big deal. And the most important thing, and this is the thing that I have against robo-brokers, is they don't match people. And they're trying, by the way. They're trying. At some point in time, they may get around to it. But they don't have the educational part of the process down. And hopefully you're getting that from your advisor, or at least being told what to read to help yourself with the psychological aspect of investing. Because it's a bear. I've been doing it for 30 years, and it's still a bear. I've become conditioned. I've gotten comfortable being uncomfortable. If that makes sense. Anyway, I got to take a real quick question. I got Greg in Parma asking. Got a question about a stock?
Yes, Bill. I own Lockheed Martin stock, and I received a notice from my brokerage account that they're doing a non-mandatory reorganization, a tender offer.
Right.
How do I know, if this is in my best interest or not?
Well, actually, you can compare the offer to what the current share price is. That's where you can start. And they're offering to buy back shares. That's actually typically a pretty good sign by a company. Lockheed Martin is huge. And it's one of those things where it's incredibly difficult to know if this is going to be the best time to sell it or not. If they end up doing well over the next year, you're going to be sorry that you sold it. If they ended up not doing so well and you sold it out at the higher price, you'll be happy you sold it. And,
okay, can I sell a portion of the shares?
You should be able to. You can tender a portion. Typically, you can, and I would actually have to see the tender offer. You can actually email me a copy if you want to. It's Bill at Bullington Capital. But more often than not, you're able to do a portion of the shares. So you should be able to do that.
Okay. Would you recommend that, or would you have to do a review?
Yeah.
How do I?
There are a lot of questions with that one, because you've got I don't know how much of a percentage of your portfolio is in there, because typically it's not prudent. Let's put it that way. It's not prudent to have more than 5% of your net worth in one company's stock. Mm-hmm. Now, prudent depends on who you're asking the question to.
Right.
I know people who have 100% of their net worth in one stock, and they look at it and they go, well, look how good it's done. Yeah, okay. Well, you ever hear of Enron? and they always think, well, that's never going to happen to me. Well, that's happened to a lot of really big companies. Compaq Computer was the second largest computer manufacturer in the world. Okay, and they get bought out for next to nothing. Kmart ended up filing for bankruptcy. Sears Holdings, you look at the performance of that over the past, and there was actually one 50-year time period where Sears, despite not having a whole lot of troubles, didn't make any money for 50 years. So every situation is a little bit different. It depends on how much of your portfolio you have in there. I don't like to keep more than 5% of my money in any one particular company, just because I've seen too many things. I've been shell-shocked too many times. So, and if you do that, then at least you're familiar with, what kind of risk you're taking. And
I see.
But that's the key. Try to figure out what kind of risk you're taking. I'm looking at the company. Their revenue past 12 months, about $49 billion. The market cap is around $80 billion. That's what the stock is selling for. If you add up all the shares and then multiply it by the share price is $264. So it's not cheap for the type of industry that it's in, but it's not grossly overpriced either. It's right within a range of right around where it should be. So if it were to go down 30 or 40%, I would say, hey, you know what? It's a little more attractive now. If it goes up 30 or 40%, I'd be saying, I'm out of here. Because it's near the higher end of the range. Okay. So if it goes up another 30 or 40%, now you're a lot higher up in the end of the range. And at that point in time, it doesn't make sense. You're just, you probably won't earn really positive returns after that in the future. It'll go sideways for an extremely long time period. But right now, unfortunately for you, you're in a zone there where I've seen that stock sell at a fraction of the current valuation that it's selling for, not the share price, the valuation, what the business is actually worth. And I've seen it sell at slight premiums to what it's selling for now too. So that is a tough one.
Okay, so how would I do my analysis? Well, what key factors should I look at? Because it's set to expire on the 15th.
Okay, what percentage of your overall net worth does that make up?
It's only about 3%.
3%? Oh, well.
3% of my brokerage account, yeah.
Okay. In that case, you can do whatever you want. It's not going to have a big impact. If you like the current price, then this is a good price. It's a fair price. But what was the offer at, though? That the share price is $264. What were they offering to pay for it?
I don't know. Where do I look to find that?
It would be in their paperwork somewhere. It would describe how they were calculating the price that they were willing to pay for it. So look that up first, and you feel free to call me in the office if you'd like to. So when you find out what they're willing to pay for it, and that'll make a big difference. Because if they're willing to pay a 10 or 15% premium, it might be worth selling some shares. If the price is significantly below where it is now, why would you do that?
Right. I see. Okay.
All
Okay,
right.
I'll take a look at that information, and I'll give you a call if I have any further questions.
Okay, well, thanks. I appreciate it. Have a good weekend.
Okay,
Yeah.
bye, Bill.
Yeah, it cracks me up at Kramer's show when he's like, are you diversified? And they've got 5 stocks. 5 stocks. Well, that's a little aggressive. But to each their own. If he's happy doing that, fine. I can tell you he doesn't do that with his money. He's not putting all of his money in 5 stocks. So I have a hard time telling somebody to do something that I wouldn't do. I have a really hard time doing that. Incidentally, it's another thing that I wanted to talk about today. Glad to jog my memory there. Annuities. There used to be a lot of really good annuity products, and we'll actually have to talk about this in more detail on a future show, because there used to be a tremendous number of annuities that were very good products. Their expense ratios were significantly lower than they are today. And the companies made these guarantees for things like death benefits and living benefits. That was an income benefit that you could get. And they were based on the old interest rates that were available at the time. And as those interest rates started going away, and as the performance of their portfolios got hit, like the stock market did 2 times in 10 years. The insurance companies have had to respond by increasing the expenses on the new contracts that are being sold. Many of the old contracts, in fact, they learned this lesson the hard way too, were fixed. I mean, you couldn't change them anymore. So you couldn't increase the management expenses. And not all of them. Some of them were smart enough to make that adjustment initially. But a lot of them, the management expense was fixed. As their costs have gone up, because a lot of people haven't made the types of returns that they thought they were going to make, and the insurance company had to step up and honor their guarantees, they've had to raise the costs on new contracts. That's why I haven't been using them in quite a while. So if you've got a contract and you're not sure, feel free. We'll do an analysis for it. There's no cost. You can email us, send us a copy of the statement. We'll take a look at your product. We'll tell you what your options are and whether or not it would make sense to consider making a change there. We're using a product that does not have a sales commission, does not have a sales charge, no contingent deferred sales charge. And then, by the way, you get a lot of people in the industry that talk, well, there are no fees. What they mean is there's no upfront fee. There's this thing called the contingent deferred sales charge. It's a penalty if you get out. We're not using those. I stopped using those a long time ago because the expenses, again, I stopped doing the annuities when the expense ratios got too high. I was not confident that I would be able to manage the money inside of that contract and make up for the difference, so I just stopped. Fast forward to today, there are products out there that have extremely low expense ratios, very low. One of the products only has a 0.25% fee. You don't get any of the death benefits or living riders, which I'll come back to that on a future show. But they're just a bare bones tax deferral. The other one's only $20 a month, no matter how much money you put in it. If you got over $100,000, that's probably the one to do, because 0.25% of $100,000 is $250. So when you get above $100,000, you're better off with the $20 a month than you are the 0.25%. So that's kind of how we do it. Both of them have a tremendous number of funds, and one of them has 340 funds inside. It's like a tax deferred. It's like your 401k plan, except you don't get a deduction when you fund it, but it does operate tax deferred. I don't know why anybody would do a non-deductible IRA with a limit of $5,500 when they could do an unlimited amount in this. Okay? Still going to grow tax deferred. You get to take out your cost basis the same way you would in a non-deductible IRA. The cost basis that you've already paid taxes on, you're not going to pay taxes on that again. And when you begin to take money out of these things, they actually give you a benefit, because the insurance lobbyists are pretty strong. Okay? They're not going to calculate the returns and say, okay, you're taking out the returns first. You actually take out a portion of your principal first, even if it is part of your return. So now that I hear the music, I'll have to wait till next week to finish that conversation. Hey, thanks for listening, everybody. You're listening to Bill Bullington right here on 1420 The Answer every week from 11 to noon. Have a good week, good luck, and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.